In this video, we are going to look at a few cases and understand how the quality of financial statements gets compromised in a variety of firms, and how, as an analyst, you should be tracking some numbers closely in order to understand what's happening with the financial statements. Right? So there are multiple cases. Please note that some of these may be not intentional from the company's point of view, but just that it was a bad choice that they made in terms of what accounting statement needed to be put up, right? So it's not necessarily unethical as much as it's a bad choice or a bad financial decision that companies have taken, right? It's not that they wanted to kind of do it in a lot of these cases, but just that they probably did not think enough before taking these decisions. Right? So let's look at a few cases and understand how, as an analyst, you could try and evaluate some of the firms where financial statements could get a little bit less quality. Right? Let's take a look at this firm. We have data of the excerpts from the consolidated balance sheet and consolidated P&L. These are excerpts, and these are for the years 2010, 9 and 8. So starting 8 onwards till 2010. All numbers are in INR crore. So if you look at the company's sales, it's a company that sales had been around 15,000 crore, 14,000 odd crore. Big company, right? Now if you look at the numbers closely, you typically realize with come up with the suggestion that 2008 was the best year. That would be your first understanding. Because why? Because sales are the highest, and because PAT, profit after tax, is the highest, and because margins are also the highest. Operating margins are the highest, right? Also, debt is low. So if you were to calculate a debt to equity ratio, that probably is not very bad. So just try and see what debt to equity would be there. Debt to equity would be total debt by total equity here. 12 by 19 is going to be about approximately 0.6. Then 16 by 24 is also going to be about approximately 0.6. That's gone up to about 0.7 here. So debt to equity has increased a little bit. And obviously, if you look at things like interest coverage ratio, interest coverage ratio is highest in the year 2008. That's fallen dramatically in the year 2010. So broadly, you could say EBIT by interest has gone up dramatically. That's because interest coverage ratio is lowest and debt is also lowest, right? Now let's broadly analyze what we are seeing here. And there is one number that basically puts a slightly different perspective to what we see. We see sales have declined, we see profits have declined, we see all other numbers have gone up. More importantly, things like inventories have gone up. Now, first things first, how do we know what sector this could be, right? So if we were to do that analysis in terms of what sector this could be, one of the primary things that come to our mind is essentially what is going to be, for example, if you look at inventory. So inventory is a current asset. Current assets by definition are those which are less than 1 year. They can get you money in less than 1 year. Look at the inventory number here. That's 12,800 crore. Look at the sales number, which is 7,400 crore. So here inventory is greater than sales. Correct? Now this is not going to get realized in 1 year. So what sector could this be? What sector could this be? Right? Typically, when inventory is huge, you are holding something as inventory that gets sold over a period of time, right? This is true in the case of firms where inventory is kind of aged. So for example, firms like tobacco, etc., where inventory is kind of held for a number of years, maybe sugar as well. But more importantly, this seems the size of the firm, 15,000 crore, looks like a firm in the real estate sector, where all the land that you hold is inventory, right? So things have become worse over these 3 years. But the question we need to ask is, was 2008 actually good, right? Let's look at one number that creates a doubt in our mind. If you look at this carefully, this number here, which is sundry debtors, which is nothing but receivables, right? Sundry debtors is receivables. That's around 1,600 here, 2,000 here, but 7,600 here. So receivables were very high in 2008, right? Which means, and they were high by an amount of about what? How much? Approximately rupees 5,500 crore extra, right? Which means whatever sales you have done, to that extent of 5,500 crore you have not recovered, right? So out of this 15,000 crore or 14,500 crore, there is a large chunk which has not been collected. Now that's something that should bring caution to our eyes when we are working as an analyst, because this is creating a scenario which could potentially be dangerous for the firm. Let's reevaluate what we have discussed so far. We are saying sales are highest, PAT is highest, margins are highest, ICR is lowest, debt is lowest. But remember, all of these are accounting measures, right? What you would realize is, because receivables were very high, cash flow will be low. Correct? Cash flow will be low. And in the real estate segment, cash flow is a very, very critical point, right? Now let's actually understand what happened in this particular company's case. So this company is DLF. In 2008, they decided to sell a lot of their apartments and complexes, etc., sell some of their inventory to a group company, right? Now under finance, that's a legitimate sales, right? What is a group company? The same owner owns company A and company B. The company A and B may not have anything to do with each other, right? So A sells to B, but B does not pay, right? That's what happened. So a group company called DLF Assets bought up those apartment complexes, and a sale was recorded to the tune of approximately 4,000 crore, maybe slightly higher. Now think about it, when will the money come? So the question we have to ask is, when will DLF Assets pay DLF? That's only when the flats will get sold, correct? Now if that is when they are going to pay, how is it different from DLF themselves selling the flats? How is it different from DLF themselves selling the flats? They are only going to get the money when the flat is getting sold. So it's like saying that both you and me are group entities. You, in order to show higher sales, I just show a bigger sale to you, but I never receive the money. The money will only get received when when we essentially sell the stuff at our end, or at your end, and then I start getting the money at a later point of time. Now that's basically a classic case of early booking of revenue, right? You should have sold those flats over maybe 2 to 3 years, right? But because the company wanted to show early revenue, they booked sales early, and they booked the sales to a group company and recorded it as sales, recorded sales and receivables. Now, the reality, however, is that they're only going to get the money once the company sells it, and in this, once the group company sells the assets, and it's not different from them themselves selling the assets. Now, in this case, this was a classic clear case of booking revenue early, and the stock markets didn't like it. The company was forced to kind of DLF, eventually kind of merged with DLF assets. So everything came back on the books. You can't have a receivable to yourself. Sundry debtors went down the next year, right? That was because there was a problem in the first year when you reported that way. There are other cases as well where there are chances. For example, if you take a company like L&T, right? Let's say they get an airport contract, right? Now, let's say they're going to make 12,000 crore of sales out of it. That's sales, and costs are 8,000 crore for them, right? And it's a 3-year contract. Now, how much revenue do you book in the first year? Correct. So in year 1, 2 and 3, what is the sales that you book? Do you book pro rata, which is 4,000, 4,000, 4,000? Do you book nothing because the government is only going to pay at the end of 3 years? This is going to come after 3 years, right? Typically, firms use a method called percentage completion method, right? So you figure out what is the cost that you have finished at the end of year 1. So at the end of year 1, out of 8,000, if you have taken a cost of 2,400, so 2,400 by 8,000 is 30%, then you book 30% of your revenue. So 30% of 12,000 will be 3,600, right? Now it's in the benefit of the firm to inflate this number because your revenue number is coming from that number, right? So if you somehow end up booking 3,200 of the cost, that's going to be equal to 40%. In that case, this 3,600 could become 4,800, right? So you can book higher sales by booking a higher cost in the initial years. And that's a key risk when companies are booking sales. Now, I just used L&T as a name. It's not to suggest that L&T does it, but if you have longer gestation projects which span over 3 years, 4 years, here also, if you think the sales should span over 2 to 3 years, if you have longer gestation projects, there is a possibility that the company might be booking revenue early. What do you track in this case? What do you track carefully in this case? You should very, very carefully track the ratio of receivables to sales. In other words, if you remember, we calculated that sales by receivables is receivable turnover ratio. We track that carefully. If that is moving dramatically, where receivables are going up as compared to sales, you need to be careful about what's happening there. The company might be using tactics to book revenue early. As an analyst, it is your responsibility to find this out, right? That's the first case we have. Let's look at the second case that we have. If you closely look at this, this is the balance sheet of a company and only the asset side. This is in INR million. So the total size of the balance sheet is close to about 11,000 million or 1,100 crore. Look at the fixed assets. So the fixed assets of the firm are now at a point of 77 million, right? So 77 out of 11,000 is fixed assets. So practically a company does not have any fixed assets. What is the biggest component you see here? The biggest component you see here is goodwill on consolidation, which is here. And that's the same last year as well, right? So we understand that there is no impairment of goodwill, right? There's no impairment of goodwill. Remember, goodwill has to be tested for impairment. Now let's look at some numbers. Goodwill is about 80% of your total assets. On the other side, you will have liabilities. Whatever those liabilities are, it could be equity, it could be debt, right? Now, let's assume the company closes today. The company closes. How is it going to pay the liabilities? So you have to pay all the liabilities, right? How are you going to pay that? You have to sell assets, but there are no assets. There are no assets. There is a little bit of current asset that is there. There's a little bit of fixed asset that is there. Bulk of your selling of the assets depends on what you get for this goodwill, right? So this company acquired two firms. This is a company called Subex. Subex went and acquired two firms. They acquired two firms and overpaid. Only then can we get goodwill. So they went and significantly overpaid for the companies, and they had a lot of debt as well for this acquisition, right? Now, when things went bad, they kept making losses. So total assets kept diminishing, right? Assets have diminished. There is no asset that is left here. So obviously, because there is no asset, there is going to be no revenue, etc. And goodwill on consolidation is going to be the biggest part of the balance sheet. Now, it is unlikely that if this company goes and closes the business, they are going to get this 8,600 million, right? They will get something far lesser. And if they get something far lesser, then in that case, they will not be able to repay the liabilities. So for all practical purposes, this company is in default territory, right? So what is the biggest red flag here? The biggest red flag here is that when you look at goodwill as a percentage of assets, and you find this number is very high. In fact, any number higher than 20% should if this is greater than 20%, that should raise your eyebrows. At this point, this is 80%, so that's a big challenge, right? What is the challenge? If the company closes today, tries to sell all the assets, it is unlikely that it will receive this money, right? So if they try to sell all these assets, it's unlikely to get back the goodwill. That's only going to happen if a company chooses to overpay the same amount for what they paid, right? So Subex acquired a company called, let's say, A. Now, if they sell A again, someone has to overpay for A. Why will they do that? They already know this is a company that is not doing well. So for all practical purposes, this value and this value, and the other point, as we said, is that there is no impairment. This should have been impaired long ago. The company needs to test every year, and if they are unlikely to realize this value, they should book losses on account of impairment. Good companies do that. We saw that Tata Steel did do an impairment. We saw that Dr. Reddy's did do an impairment, right? So if you have overpaid for an acquisition, it makes sense to go and do an impairment at that point, which is what this particular company did not do. The stock price when they started with doing the acquisition was close to about 600 rupees, and by the end of this entire exercise, the stock price was at 6 rupees. So there was a 99% fall in the stock price, because this is going to create a big problem. This is on paper, this is intangible. You have paid more for a company, but you're not likely to receive it back. So when you see goodwill is a big proportion of your asset base, you have to be careful, right? If this number is high, you have to be extremely careful. That's your check, that's your red flag, right? That's our second case. We take more cases in subsequent sections.